2022 was very challenging for ICICI Lombard. The insurer saw high COVID-related claims, faced growth headwinds in the motor segment, and the merger with Bharti AXA weighed on financials. However, Q1 earnings indicate that FY23 could be a year of revival. The growth in motor segment is set to rebound with improved volumes. While the revision in third-party motor tariff rates is not in line with claims inflation and is also below the industry expectations, higher penetration benefits can outweigh the pricing issue to some extent. Also, ICICI Lombard has made huge investments to grow its retail health agency channel and added around 1,000 headcounts in the past 1 year. Consequently, management expects growth in retail health premium to accelerate in the next few quarters as the agency managers start getting more productive. Moreover, there will be operating synergies and cost savings from the merger. Since Bharti AXA operated at higher expense ratio, there's scope of improving operating efficiency by reducing overheads, whether it's branch cost, branding or marketing costs. Management expects annualized synergy benefits of 200 crores in FY23, which it plans to reinvest to grow the business. Progressive reforms and regulatory changes would also aid business growth. ICICI Lombard's GDPI increased by 28% on a year-on-year basis in Q1 FY23 compared to industry growth of 23% in the same period. Consequently, its overall market share improved to 9.9% by June end. The acquisition of Bharti AXA added to market share gains. Growth in the premium segment was driven by motor and health insurance segment. Motor insurance, which is the largest segment for ICICI Lombard, saw growth in line with the industry and it's maintained its leadership with a market share of 11.3%. In an interesting development, ICICI Lombard is readjusting its motor vehicle portfolio away from private cars given the pricing competition. Instead, it plans to focus on growing the CV segment. Accordingly, the proportion of CVs in the motor insurance mix increased to 24.6% in Q1 of FY23 from 16.6% in Q1 of FY22. Health insurance saw robust growth in FY22. While retail health growth has moderated, growth in group health and better pricing led to the overall growth of insurance segment. Commercial segments like property and casualty saw a healthy 14% YOY growth, largely in sync with the economic environment. ICICI Lombard's combined ratio, which is a measure of an insurance company's profitability, declined to 104.1% in Q1 FY23 from 123.5% in Q1 FY22, thereby reducing the underwriting loss. The combined ratio of above 100% indicates that the insurer is paying out more money in claims and operating expenses more than what it receives in premiums. Combined ratio is the sum of loss or claims ratio and expense ratio. Barring the motor OD segment, claims ratio improved across all segments. But bulk of improvement in loss to claims ratio was driven by health segment, which saw claims ratio fall 74% in Q1 FY23 from 148% in Q1 of FY22. The expense ratio also declined by 210 basis points YOY, which remained higher than the pre-COVID levels of below 30%. The higher expense ratio is mainly due to the merger with Bharti AXA that operated at a much higher expense ratio and also because of increased investments in the distribution channels. Though investment income declined, it's more than compensated for the underwriting loss, leading to a profit in Q1 FY23. Now, due to subdued capital markets, unrealized loss stood at 582 crores as of June end. ICICI Lombard's ROE declined to 15% in Q1 FY23 from around 20% in the previous fiscal years. Given that it wants to keep investing and grow the book a bit faster, ROE will continue to be in mid-teens going forward as per the management. Obviously, investment should lead to better underwriting performance in the future. At the current market price of around 1240 rupees, ICICI Lombard is trading at a pricey valuation of 6.4 times trailing book value, which is undoubtedly very rich. However, its premium valuation will sustain given market-leading share in a secular growth sector, fairly diversified product mix, strong multi-channel distribution network, solid technological prowess and strong solvency profile and healthy profitability. Following the merger with Bharti AXA, parent ICICI Bank's stake in the subsidiary has come down from over 51% to 48% post the deal. Now, this has implications as ICICI Bank will have to bring the stake down to 30% over a period or increase it to above 50% as per regulatory requirement. Now, in September 2020, the government gave ICICI Bank 3 years to comply with this regulation. We do not see ICICI Bank selling 18% equity stake in an ICICI Lombard. In all likelihood, it may increase the stake once again to beyond 50% within the stipulated time. Therefore, any weakness in the stock price due to speculation of the supply overhang should be used as an opportunity by long-term investors to add the stock.